Buyers are still fighting over properties, still multiple offers on properties, and it's interesting to see, and it's a good thing to see. But what we're running into now is a bit of a stalemate in the market where sellers are scared to list, and that is slowing down the market in a whole different fashion. So the sellers that are listing, most of the time, not in all cases, but most of the time, they're reaping the rewards of listing with very little competition. And I'm going to discuss that with Shant, and Shant's going to get into it and talk about what he sees from the mortgage side. So what I'd like to do is get Shant in here and introduce you all to him. Shant is a great mortgage broker who has been in the business a very, very long time. Here he is. Hello, sir.
Hey, what's up? I didn't know it was going to be so close.
I didn't either. But Shant's been in the business a long time, and he happens to be, I'll tell you because he won't, he's the #1 mortgage broker in the country, having done thousands of mortgages just in the last 12 months. So I don't just bring all our buyers and sellers, anybody. I bring the best. And Shant, I would like you to jump in and say hello.
Yeah, it's been super interesting. Thank you guys for having me. I always love doing this kind of stuff. And you always ask some really good questions. So I'm fired up to talk about it. It's been super interesting. I would say we do 90% of our business here in Massachusetts, but we're doing business all around the country now. So it's been really interesting to see kind of how things have been impacted, how people are, taking in this information and changing the way they want to do business in terms of the type of homes they're looking at, where they're looking to move to, whether they're ready to move forward or whether they're afraid and pull back. I've used it as an opportunity to learn and just talk to both agents, attorneys, and clients, and just ask some questions in terms of kind of trying to do some analysis or digging or just finding out how people react to these situations. And it's been mind blowing. I am, to your point, surprised and happy to see how busy it's been. You made a great point that I was going to touch upon as we were talking. I can't imagine how busy it was going to be this year had this not happened, because our economy, our unemployment rate was at record low levels. Stock market was booming. All these things were going good. And that's still the momentum that's pushing us through this right now. Now, I think low mortgage rates have helped fuel it and give some confidence. I think that certainly helped in terms of being an equalizer to make money cheaper. But, to see the numbers that you just showed and the numbers you've been showing and seeing the numbers on our end in terms of purchase applications, refinance applications, it just shows how strong things were. And I think it also, whether most people admit it or not, shows how confident they are in our economy recovering and seeing the actions that are being taken by the government and seeing, that there's confidence that we are going to get through it. And I think that's also super important.
I totally agree with you. And, it's been an interesting ride, no doubt. I remember the beginning of it, we were all calling each other saying, what is going on here? And one of the first things that happened was rates just plummeted. And I remember talking to you and you were saying, Anthony, if I work 24 hours a day, I couldn't keep up. It's just not possible. I have to sleep. We actually had that conversation. But tell me, where were rates before it happened? What did they go down to, and where are they now? 30-year fixed rate in a normal situation.
Yeah, so I'll just cover average 30-year fixed rate. So it's important to remember that rates were already down last year. So in 2008, at the peak of 2018, we talk about 2008 so much, so I threw that in there. But at the end of 2018, rates had gone up. There was a lot of confidence that the Fed was pulling out of the market and that the economy was going to kind of run itself. They stopped quantitative easing. Stock market was up. All those things were happening. And so rates have gone up all the way to 5%, right? For a little bit in October, November of 2018, we're at 4.8755. Then they came down last year. And at this time last year, they were just about 4%. Okay, so they went from high 4s, 5%, came down almost a point to 4%, 3.875, and here we are now for the first time in my career, and where they've been over the last couple of weeks has been, a lot of clients are getting, pretty much everybody's getting rates either in the low 3s or high 2s. We've had some clients lock in 30-year fixed rate mortgages, 2.99%, 2.875, like ridiculous numbers that I never thought I'd see in my career. And that's given massive confidence on, these are on purchase loans. There's two caveats. One, we're seeing the best rates on conventional mortgages below the Fannie Mae and Freddie Mac loan limits. So in Worcester, that's $510,000. In Eastern Massachusetts, Boston, and the surrounding counties, go up to $690,000. But the reason those rates are better is because the government, the Federal Reserve stepped up as buying mortgage-backed securities at a unprecedented rate, and that's keeping rates low. Jumbo rates are also amazing. They're just not for a long time. They were better than conventional rates. They're about 0.25% to a half point higher. There's a little bit more instability in the market, but the Fed's doing everything they can to promote homeownership. And I've said this before. They don't want, a health crisis definitely turned into an economic crisis, and they're trying to prevent it from turning into a housing crisis. And I think the way they know how to do that is by, stimulating, money and having rates come down. And they're also done a lot of other help with forbearance and all that kind of stuff. But they're trying to do everything they can for homeowners to stave off short sales, foreclosures, and missed mortgage payments.
All right. So rates right now, typical 30-year fixed rate. What is it?
Call it like low threes, like 3.125 would probably be the average 30-year fixed rate for a client.
All right. And right before COVID happened, what were they? 3.5?
Yeah, they probably 3.5, 3.625. Yeah, about a half point higher.
So they came down about a half a point.
Yeah, but the difference this time is that right after COVID happened, there was massive instability. One day rates would be great. Mondays and Tuesdays rates would be amazing, and then by Friday it'd be a point higher. It was terrible. It was not fun for us, not fun for clients. It just created more panic. So with the Fed, the difference this time is once the Fed stepped in, they signaled, here's what we're going to do, and they're committed to doing it. So it's creating just massive stability in the market. So I actually think rates are going to be low through the end of this year and into next year. I think we're going to see super low mortgage rates. We got two things going on right now. We got, it's not spring anymore, but we got a spring market going on, in the summer, right? And then we've got a massive refinance boom going on at the same time. It's wild.
Yeah, it totally is. Now you mentioned jumbos. Tell us quickly, there were some rumors 2 months ago, jumbo market's going to disappear. People aren't going to be able to get mortgages. Can you just spend a minute on that?
So I've talked about this before. I mean, what's happening in the jumbo market is like, I've said this before. It's a logical reevaluation based on the market changing. So what's going on in the market is that there's been massive job loss. There's been unemployment went from 3% to almost 15%. Fortunately, it started coming down a couple of weeks ago. We had a great jobs report 2 weeks ago, which I was really excited about. Yep. We've got massive fluctuations in the stock market. 1 week is great. The next week it pulls back. It's come back up over the course of the last couple of months, but it started to pull back a little bit, and I'm sure that's going to continue, right? So you've got people's income and their assets being impacted, and so lenders don't know what's going to happen. Like lenders and the big banks and anybody who lends money, whether it's a car loan, student loan, or mortgage, they don't know how people are going to be able to afford to repay these things back. So what they do is they pull back their guidelines and they become more conservative. Now, it's important to know that over the last 3 or 4 years, like I said, unemployment was low. Income was going up. Mortgage defaults were low. Home prices were increasing. All those things are positive. So lenders started getting more aggressive. They started offering products they wouldn't normally offer. They lowered FICO scores. They raised loan-to-value requirements, allowing for lower down payments. They came out with products that didn't exist 4 or 5 years ago, right? So they became more aggressive. They just pretty much eliminated all those. We went back to where we were at 4 or 5 years ago.
Which is 4 or 5 years ago was 20% down.
Yeah. Look, here's what I would say. What's disappeared in the jumbo space, there's still plenty of jumbo mortgage business happening out there. We're doing just as much as ever. We're just doing different kinds of jumbo business. So what I mean by that is, the FICO score restrictions over the last couple of years, things got a little bit easier. If you had a 660 or a 680 FICO score on a jumbo loan, you could get a loan. Now you pretty much need a 700 FICO score across the board. A few months ago, you could get a jumbo loan with 5% down, and 10% was no problem. You had a million different ways to do it. Now 5% is pretty much gone, and 10% you got to get. There's much less investors out there. You can still do it, but stricter requirements. They've increased reserve requirements. So maybe some products required 6 months reserves. Now they require 12 months. So it's not like they just poof disappeared. They've just tweaked the guidelines to become more conservative and to protect themselves. And, it's smart. They were trying to protect not only themselves, but protecting the overall housing market so they can withstand a pullback a little bit. And people, again, don't default. But so higher FICO score requirements, more reserves, larger down payments, but certainly not gone. I mean, it's not, I wouldn't even say, and I don't know this number, but it's not like 50% of the mortgage capacity disappeared in the jumbo space. Maybe 20%, but they pump it. The people
the media loves it.
The media loves it, and frankly, unfortunately, and I see this happen in our industry, and happens in every industry. The lenders that are pulled back, they go out there and they say that everybody's doing the same thing, and that's not the case. I would say this. There's some products that we don't do anymore that we used to do, and there's a lot of products that we're doing more just as strong as ever.
Let's flip. So what you just explained was all related to jumbo. Let's flip to FHA for 1 minute, and then we're going to go into more process stuff. But FHA was one in the beginning. The rumors were flying everywhere.
Yeah.
It was no more FHA. You were like, no, FHA didn't change a thing.
Yeah, that was crazy. I mean, FHA in a lot of ways made things a lot easier, in terms of appraisals and how to verify income. They gave us guidance. In terms of their guidelines over the course of the last 3 months, almost no changes, right? The lenders that offer FHA loans increased some of their FICO score requirements. And I saw huge variations. For example, I'll talk about our company. We went from a 580 FICO score to a 620 FICO score, right? Some lenders went to 680. Some stopped doing them altogether. A lot of lenders, put in massive overlays. But, I wrote 2,000 loans last year. You know how many FICO scores I did below 620 last year? 1, right? So it's not like it's not a massive difference. Like the impact to borrowers was very small, right? And frankly, I believe a lot of the changes that were made were in the best interest of the client, because ultimately before the economy was a little bit more stable, right? Things were good. In an unstable market, people with lower FICO scores and lower down payments, a lot of times those are the people that are going to lose their jobs first. And so, we want to make sure we put our clients in a position to succeed and be able to afford what's their biggest expense, and not get into trouble from a housing perspective.
100%. That makes sense to me. Now, talk to me about the mortgage process. You just mentioned some different things in there. In some ways, 20 points more on FICO is needed, and that. But what about like people giving you bank statements, pay stubs, tax returns? Has any of that gotten worse?
So here's what I would say. I think that all that stuff I just explained, at the end of the day, we can get through all of it if you just take a little bit more time to prepare, right? If your FICO score is not where if you were to say to me, hey, Shant, what should a client do in this environment? I'd be saying, just get prepared. Like, don't take anything for granted, because you can't make any assumptions as to whether you're going to be approved or what you're going to be approved for, or anything like that. I think it's really important to just take a little bit more time, right? Like in terms of if your FICO score, a 20-point FICO score difference, I can sit with somebody, do an analysis of their credit report, and tell them things they need to do in advance to get their score up 20 points and qualify for the credit score they wouldn't have. In terms of income, you can work with a borrower in terms of, hey, there's certain kind of debts you might need to pay off in order to prepare to purchase a home. There's certain, there's debt you can pay off. There's additional income we can utilize to qualify. Sorry, we had a client coming in to drop off.
That's okay. No problem at all. Listen, I spoke to someone yesterday who 3 years ago had a car repossession.
Yeah. And
they worked it out with the bank. They paid the difference from what the bank sold the car. And they said on their credit, it's still showing that they owe the total balance. And I said, you need to get in contact with them and get that worked out. Well, I'm not worried about buying a house till the fall. I said, that's right. Get in contact now. Is that the right advice?
100%. So that's probably the 1 out of every 4 credit reports has a mistake a flat out mistake, like an error, right? Okay. I had a client that I was talking to this morning, seriously, on the way to work this morning. It said he was deceased, right? Like we couldn't get a credit score. I was talking to him on the phone, so I knew he wasn't. But I knew it to get it fixed. So, so there's errors that you wouldn't know about, and there's things that linger on there that you wouldn't check. I talk to a client every single day in which they have a tiny little collection account that they don't know about, whether it's a cell phone bill or a medical bill, or there's a missed payment that they didn't know about that's negatively impacting their scores. And we can work with them in terms of 1, identifying it, 2, letting them know how to fix it, or 3, putting them in touch with somebody that's a credit repair expert, or even just having them work with the original creditor that put it on there. So credit's probably the one thing that time is so important. So like that advice you gave to that person, really great advice, because now it's not a big deal. They can fix it without the stress and anxiety of getting an offer accepted or qualifying for a mortgage right at this minute. I
told the person, I said, look, you should make the call to Chase. I mean, these are real problems that people have, so I think we should spend a minute on it. I said, call Chase, try to get it ironed out over the next few weeks. If you can't, I'll get you connected. I mentioned you, and you would get them connected to a credit specialist to get that worked out long before they want to buy a home.
Yeah. I mean, it's, I would say this, credit's a good example. Income's another good example. I can't tell you how many self-employed borrowers, so if you're a borrower that is either self-employed, earns a big portion of your income utilizing overtime, commission, bonus, all that kind of stuff. Those are all things that we can plan for in advance to make sure that we're considering those when they're going to come in, if they're going to come in, and how they can impact your borrowing power in the future. Because you can use things like that. You can also pay off debt. I just got off the phone with a client that I gave them some advice. They're making an offer on a beautiful home today. I spoke to them a couple weeks ago, advised them to pay off certain debts. They took my advice. Now they can qualify to get a pre-approval for this property. Had we not spoken a few weeks ago, I'd be saying, sorry, this is not in your budget anymore.
And am I right to say that sometimes when people do that, pay off certain debts, their credit score goes up a few points? You can actually give them a better rate because of that.
Yeah, it impacts interest rates. I would say this, if for everybody that's listening today, high credit scores, anything you can do to impact your credit scores is going to save you thousands upon thousands of dollars over the life of your loan. Over the life of your budget, right? So, mortgage companies impact interest rates, based on your credit scores. Your car loans do. Your credit card lenders check your credit scores and determine the rates you get. On top of that, landlords are looking at it. Your employer's looking at your credit. Everybody's reevaluating, and the better your credit is, then you're deemed less risky, and in turn you get better borrowing rates. And you'll save. It's not. I have clients. You could have clients buying the same house, getting the same loan. Person with a great credit score versus a person with a low credit score, a lot of times can save hundreds of dollars a month. So over the course of a 30-year mortgage, you're talking tens of thousands of dollars. So it's really taking credit seriously is a big deal. And I think really getting educated on it from somebody who knows what they're talking about is something that everybody should do.
Okay, thank you. Now, documentation. You're still asking for the same things, but I understand that now you guys want stuff like up until closing.
Yeah, so that's just a result of the market conditions, right? So we're pretty much asking for the same things. In the self-employed world, it's changed a little bit. But I'll explain that in a second. But for your normal W-2 employee, a borrower, what's happened is, again, the things I mentioned earlier. There's been job loss, and there's been massive fluctuations in terms of the markets, right? So in the past, 4 months ago, we would ask for your pay stub at the beginning of the process, and we would just verify you were still employed at the end. But now what's happened is people have lost their jobs, and on top of that, you've seen a lot of companies, do reduced hours, reduced salaries, to try to kind of get through this. So now we're asking for your last pay stub, and this is when I say we. The industry is asking for your last pay stub right before closing, whenever that is. They can tell based on the previous pay stubs we've gotten, and they're checking that to make sure, one, you're still receiving income, you're still employed, and then two, you're still getting paid at the same clip that you started it out. So we're basing your loan approval off your current income. The other thing we're doing across the industry is that, and this was a big change, and it was a little bit rocky for the first couple of weeks when it happened across the industry. I kept hearing about it. Again, because of fear of, millions of Americans unfortunately losing jobs at a record clip, they're doing, we used to be required, 4 months ago before COVID to verify your employment up to 10 days prior to closing. So we would just call your employer to make sure you're still employed, ask a few questions, and be done with it. Now it has to be done within 24 to 48 hours of closing. So a lot of times it's even happening the day of closing to make sure that, our borrowers are still employed when they're getting the mortgage. And, the reality is that in some cases we found out they haven't been, and that's not great. That's not a great phone call to get or to make, because unfortunately it's bad news.
Well, and let's spend 1 minute on that, because I want to make sure buyers know that. And we've talked about this over the weeks when you put the bug in my ear 2 months ago, is buyers should not get frustrated or offended when someone from a mortgage company, like in an underwriting department, calls their place of work the morning of closing, the night before closing. They should expect that for verification of employment.
Yeah, that it's a great point. I mean, what I would suggest to buyers out there is, like, if you're going into the home buying process, and I understand it's a private thing, you're buying a house, you don't want to, some people don't want anybody to know or announce to the world that you're buying a house, especially at work. But, I would figure out a way to make sure you've got your HR person or whoever verifies your income and payroll, or your direct manager's contact information, and know how to get a hold of that. Because keep in mind, most companies, not everybody, but a lot of companies everybody's still remote, right? So from a mortgage company, we're calling the employer and trying to verify employment. A lot of times we can't get a hold of anybody because all we have is the office lines that are listed online. And so that's when the frustration happens because we can't reach anybody. Nobody's calling us back. So we've been doing to our clients, we've been advising them at the very beginning of the process, like, we are going to do this final verification. We just want to let you know from now, it might be a good idea to get your HR, payroll, or manager's cell phone, personal email, whatever, just so we can get a hold of somebody, just to make sure that it doesn't go dark for a couple of days, especially when we really need them at the last minute. So just trying to be proactive, also letting them know that we're going to need your last pay stub. So before we'd say, send us your first 2 pay stubs, and a lot of times we'd be good. Now we're telling our clients, every time you get a pay stub, just send it to us, whether we ask for it or not. And same thing with the bank statements.
So that's super. I mean, that's a really good nugget, really good tip that to give to buyers is, hey, figure out who at your workplace is the person that should verify to your mortgage company. Give them a heads up that you're buying a home. Just that person. Get their information, get it over to you so that you can forward it to underwriting. Because one thing I also want to make clear, you, the mortgage broker, you're not calling to do employment verification. That's separate from you. That's the underwriting department that's approving the funding.
Yeah. There's so much stuff changing. I mean, we could talk about this and it's probably going to lead to a whole different conversation, but we have clients now because of remote, a lot of employers have come out and said, hey, we're fully remote. Like, you don't have to come back this year. Right. So you don't have to come back into the office. You can work from home, whatever. So we've had a lot of clients start buying homes, and I've done more business in Vermont, Maine, New Hampshire, and upstate New York this year than I have in the last 10 years combined.
That's
right?
amazing.
People are going everywhere, and they're like, if I don't need to be here, I feel safer away from wherever they're at, whether it's big city or whatever. We're seeing an exodus a little bit for sure. And so, but as a lender, I need to verify that your employment is not going to be negatively impacted by you relocating out of state. So we have to get that confirmation from their employer. And so that's something we're having with our conversations with our clients up front. It's like, listen, yeah, you can buy this as your primary residence. We're okay with that. However, we need to verify that your employer knows you're leaving the state and is going to keep you employed at this time and also at the same salary because you're leaving. So you can't, a lot of times you can't really hide it from your employer if you're going to call it your primary residence. Now, if you can afford to, maintain it as a second home or a vacation property, that's a whole different story. But if you're calling it your primary residence, that's a conversation your employer is getting involved in.
Okay, that makes sense. Thank you. And I want to get into talking about sell-by situations. But before we do that, why don't we answer Samantha Martinez's question? She's a great realtor in our company. How long do you need to be back at work from furlough to apply? Yeah,
so we've fortunately, it's been great. We've seen a lot of clients going back to work over the last couple of weeks as things have been opened up. So we just need 1 pay stub. So it's not an amount of days. We just need you to be back to work. We need to verbally verify that you're back to work full time, and we also need to get your first pay stub when you get back to work. So it's not, everybody. It just depends on what their payroll cycle schedule is on. Some people get paid weekly, some people get paid biweekly, and some people get paid twice a month. So it just depends on when their next cycle of payroll is going to be after they come back, and shows that they've been back to work for at least 1 full week. So I know that's a big answer.
Am I right to say that it wasn't like that before COVID, and you
Correct.
guys, Fannie and Freddie, loosened that because they knew there would be a lot of people going right back to work?
Yeah, honestly, having done thousands of loans over the last 10 years, like I can't remember how many furlough cases I even dealt with before, this is something that we're dealing with that's pretty new in terms of furlough and going back to work. Obviously, we've had people laid off and whatnot, but
of course.
With this furlough piece or unemployment, finding a new job, a lot of cases, if you find a new job, it's easier because from a lending perspective, because a lot of times we can use the contract they get, their employment contract, as long as they passed all their background checks and a verbal verification. We don't need to wait for the pay stub. But if you're returning to work, we need to make sure that you're going back, because it's not just, keep in mind, it's not just you, the borrower. The lender also wants to make sure they want to see that the employer is viable. They want to make sure it's not like, if they furloughed you, clearly there was an issue there. They want to make sure you're coming back and that the employer is actually going to be able to pay you too. It's not just a matter of, they want to see you get that money.
Of course, that's what it's all about.
Yeah.
Now, let's jump for the last 5 minutes. You heard me in the beginning. You were in the broadcast waiting room. Let's take one more question. What is the minimum FICO score in Mass to be approved? Well, that's a kind of a wide-ranging question, but go ahead, answer that.
Yeah, I mean, I would say there's no minimum FICO score requirement for Massachusetts specifically. I would say that for the most part, and there's exceptions to this, so I'm sure somebody's going to prove me wrong, but for the most part, most loan products in the conventional mortgage space that I'm seeing are 620 is the minimum FICO score across that I'm seeing for most lenders. There is exceptions to go below that, but not a lot of it. And in the jumbo space, I'm seeing that 680, 700 and higher. So it's depending on the loan product, the loan type. There's not just one FICO score. Every bank has the right to do whatever they want. But I'm not seeing a lot of business being done under 620. Put it that way.
Makes sense. Let's jump to sell buys. You and I both know, it's something we've all dealt with for years. You get a seller that wants to sell and they want to buy a new home, but most of them don't choose to be proactive and tell a realtor, interview a realtor in advance of them finding a home. Most of them wait until a Saturday afternoon when they see a house they like. They freak out. They call a realtor. They call a mortgage broker. You're, having fun with your kids on a Saturday. Suddenly they need a pre-approval immediately. So let's spend a few minutes on, the right way that a seller could go about this and a sell by, and some of the things that they can do, because you and I both know them, but we're here to talk mortgages. So why don't you go over that a little bit? Yeah.
So keep in mind. So it's interesting timing on this because what's become a little bit harder, right? In the past, you'd say, well, what about a bridge loan, right? Bridge loans, for the most part, they were starting to come back over the last year or two, completely gone, right? I don't know anybody doing bridge loans right now. Massive fear in the market in terms of, again, anytime there's instability, lenders get conservative. Well, a bridge loan's a very aggressive loan product because essentially you're giving the borrower ability to put, two houses on the market. And, we know we're talking about the market, how fast things are moving and all that kind of stuff. But, things could change, right? So before, the common thing was, oh, I'll just get a bridge loan. I can't tell you how many people call me and was like, hey, I need a bridge loan, or hey, we'll just do a bridge loan. It's super easy to get. It's an extremely hard product to get, and it's very rare, right? Almost non-existent now. Now, what's become really hard to get over the course of the last 2 or 3 weeks, specifically, maybe a month now, is home equity lines. What a lot of clients would do is they'd go out and get a home equity line on their house. They'd use that as a self bridge. They'd go out, have access to their equity. That's what a home equity line of credit is. You can pull some money out, use that for the down payment on the new house, or use that for your earnest money deposit on the new house, and then buy the new house, sell your existing house, and everything gets paid off. Well, getting lines of credit just got harder, much harder. A lot of banks are not offering them anymore. They're putting restrictions on them. That's been a product set that's been totally impacted. So that self-bridge product has also become harder. So it's really, really important more than ever. One thing is, before you even let me know that this is what you want to do, is making sure you're identifying your realtor, hey, I probably need to sell in order to buy this next house, for the down payment, for being able to carry, my income maybe not be able to carry 2 mortgages, and then talking to a mortgage professional, figure out what their options are. Sometimes, we can figure out lower down payment options or a home equity line or some sort of loan product that will allow for it, depending on the strength of the borrower. But in a lot of cases, they actually really do need to sell in order to buy. And then you've got timing issues. You've got, and then you've got the whole sake of what happens if something goes wrong, it doesn't go according to plan. So, bottom line.
But I want to say, all of those things can be handled if the planning is done in advance.
That's what I was just going to say. I mean, that's what I was going to say. Bottom line is you can figure it all out if you plan in advance. That's not the Sunday night call that offers are due on Monday morning and I got to sell and buy at the same time. That's sitting down, being proactive with your approach, assembling the right team of realtors, mortgage people, attorneys, really just kind of having the communication be well-rounded, having a strategic plan as to how you're going to time everything, having a contingency plan. That's not all stuff that can happen in 3 hours. We successfully helped clients 4 years in many different markets, up markets, down markets, sell and buy at the same time. We've been doing it successfully all the time. That's not going to change. But it does. The clients that have the most success with it are the ones that proactively plan and listen to the plan, and then they win.
Now, one of the things that I always teach in my training, and you've helped me with it over the years, is having the realtor make sure to tell the seller on a listing appointment, okay, we agree your house is probably worth, I'm going to use hypothetical numbers, 500,000. And you owe how much in your mortgage? You owe 300. Okay, so after closing costs, blah, 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 totally hypothetical numbers. But you're going to end up with roughly 175,000 after all is said and done. You love it when people bring and tell you those numbers before they happen. And then what I've seen you do over the years is you'll talk to them about, okay, that's scenario one. If scenario two is the house doesn't sell at 500, it sells over asking at 525. Now you can buy for more. If it sells at 475, you can buy a little less. So I've seen you, and I'm sure you still do it, give people a range of like, hey, if your house sells at this, you'll be able to qualify for that. If it sells for that, you'll be able to qualify for this. And to work and iron those things out in advance.
Yeah, I mean, you're 100% right. I mean, there's so many misconceptions. I have clients come into that. We do those exact scenarios. We have clients come in and, well, they automatically think, in order for me to be able to pull this off, whether they're selling and buying at the same time, I need to put down 20%. And there is great loan products out there still with 5% down and 10% down in the conventional mortgage space. And those are valuable because, I think homes are expensive around here. A lot of times you can open up the inventory for yourself if you put down a little bit less money, keep some money for renovations and improvements and furnishings and stuff like that. So there's just, bottom line is like our job as lenders is to collect the information, analyze it, and provide you with options, right? And whether you're selling and buying or just buying, that's what we can do. And so the more information, if you are selling and buying, I generally love it when they talk to a real estate agent first, because then I can actually ask them questions like, well, how much do you really think you're going to sell for? How long do you think it's going to be on the market for? When are you listing it? Because then it's like, the worst is when somebody says, well, Zillow says it's worth this. And it's like, well, how am I supposed to plan based on a Zestimate? So it's when they talk to somebody who's experienced, that really knows what they're doing, that's giving them good advice. And then, what are you going to do if you put your house on the market and there's 25 people that want it, and and they all want to, like, what kind of leverage does that give you? Like, it actually allows me to ask really good questions in terms of where are you going to go? Are you going to rent back? Like all the things that you guys talk to them about. But it helps them start kind of seeing it and being more real. And what that does is that eliminates stress and anxiety when those things all start to happen. And now you've got a confident buyer and a confident seller. They're prepared, they're empowered, they're ready to go. And those are the clients that tend to have more success in a really tight inventory market.
That makes perfect sense. And, I know when you guys do that, you'll give them a pre-approval subject to their home selling. But when they do that, then they can go on the market. They can disclose that the sale is subject to the seller finding suitable housing. They can show that they've been pre-approved. And then when they see the house they want, they're ready to strike. And that's often what we see people not do. They usually wait. I don't want to say usually, but this. I'm preaching to the choir. People, I don't want to list my home until I find what I want. They find what they want. They make an offer. They can't get it because they haven't taken any steps with their home. Their home's not ready to be listed. And then they lose out and they're back to square one.
Yeah. And look, the opposite happens too. I have really frank conversations with people like, listen, unfortunately, you don't have an option here. Like, you have to sell, right? And that's important to know as well. Like, there's a lot of ways in which we can get crafty and figure out ways and give really good advice. And there's also really just honest conversations about expectation setting. Like, there's truly people out there that have no options. Like, they really need to sell in order to buy. And I think it's really important to understand that too, because then it leads to just like, then you really start planning as to how you can make all this happen. Because moving a lot of times, is a necessity. It needs to happen. You need to upgrade or downgrade or whatever your situation is. So right. I think just the more information that you have, the easier it makes the process.
I agree 100%. What else do you want to add for mortgages? And let me look if we have any other questions.
Yeah, I would say, from a mortgage standpoint, again, I was wrong about a couple things about, I always admit, I know you do the same thing. You'll admit when you're wrong and you admit when you're right. Two things that I missed on just initially at the beginning of this whole process, because I saw, the industry constricting a little bit. I saw unemployment happening. I saw the markets going up and down. Like you, 2008 is fresh in my mind of like the financial crisis. So I immediately thought, everything's going to pull back, and I didn't see the second home market booming like it is. Okay. There's a massive, it's not like people are going out and buying like luxury second homes. People are buying homes in the Cape, in Maine, Vermont, New Hampshire, Florida, places just to get away, right, and have space, and for their families and to get outside. And the other part is I am starting to see, at the beginning of this year, I was going around to every single real estate office and I was talking about an interesting trend. And I was talking about a trend in which houses were getting smaller because cost to build was going up, and labor was going up. So across the country, last 4 years in a row, houses actually got smaller, right? Brand new homes. And I think that's going to change. I think you're going to see the new trend. Things are going to get a little bit bigger. In my opinion, that's what I'm starting to see from clients. People are moving. As I'm talking to my clients, I'm like, why are you moving? They're like, I'm home all day. I work at home now. My kids go to school at home. I work out at home. I entertain at home. You're seeing pool sales go through the roof.
Oh, yeah.
So people are reevaluating their housing situation. And so I think that's really important to budget, right? And to understand what kind of down payment you need, what kind of rates are out there, what kind of monthly payments are going to be, because people have, certain clients have a need because they're reevaluating their circumstances and their situation and the use of their home. And so I think that budgeting piece, before you emotionally go out and make a decision, I think it's really important to talk to me or a qualified mortgage person and just really understand what it means. Because I think those two things are happening. And you're seeing also I was also seeing people pull some money out of their homes, do cash out refinances or construction loans to go out and increase the size of their homes, or as additions or upgrades or renovations, again, because they're spending more time there than they planned on before. So it's been an interesting shift.
You mentioned pools. What my dad does. They've gotten more calls for patios in the last 4 weeks. He said he's gotten more calls in the last 4 weeks than he did in an entire spring in his career. In just 4 weeks, he's getting hundreds of calls, people wanting to put patios in, and it's just shows that things have changed. We do have a question here from Kenda. What are you guys doing to help make homeownership more equitable? How can we increase the number of Black homeowners in Mass? It will be excellent to hear what both of your firms are doing in this avenue. I'll let you answer that, or I can jump in. Go ahead.
If you want to run with that one first, I'll let you take it.
Well, what I was going to say is obviously lending guidelines aren't set by Shant and Anthony. Those are set by Fannie, Freddie, FHA. Yeah. And I don't believe, correct me if I'm wrong, you'll know better, I don't believe there's any disparity in the guidelines based on race, correct?
Yeah. No, yeah. We collect that information, in terms of on a uniform residential mortgage application, the powers that be have determined that's very important information to collect and utilize it to figure out who's lending where. I will tell you that, we lend everywhere. We market to everywhere. I do a lot of business in Boston, outside of the suburbs, all across the country for that matter. So most of the business that we work with right now comes with, from the network of people that we know. I will say on our end, we're going to try to learn and figure out how we can do better there. This is obviously a big topic in the world right now, and we're paying attention, and we just want to educate ourselves on how we can do better. But I don't have an answer on that right now, but I know that we're committed to doing better in those markets.
Yeah, and part of the question also was just, how do you make it more equitable? And what it really comes down to is, I wish Shant and Anthony could have an impact on how to make homeownership as a whole more equitable, or on who can borrow and what advantages we could provide. We obviously can't, but if you look at, I can answer that one too. You look at housing data over the last 20 years. Yes, after 08, we went down. But if you look at, year 2000 to 2020, what's happened to home values? I was talking to someone the other day. Actually, you and I had this conversation in 2005 when we were amazed that a 2-family in Watertown was worth $500,000.
Yeah.
So we sell 2 families in Watertown for $1 million, I don't know, every week. So, you look at housing as a whole, it's obviously important. It's obviously the value of home ownership is tremendously important and impactful on our market. And, the best advice that I can give, and I know Shant will echo me, is if you are a buyer, you need to talk to a mortgage broker and a realtor before you want to buy. People have this thing in their head, Shant, you should spend a minute on that and then we'll wrap it up. They have this thing in their head that if they call a mortgage broker or they call a realtor, we take that like they're going to buy right now, or they have to buy right now. Talk about how many people you talk to 6 months, a year, 2 years before buying. Spend a minute on that.
Yeah, I mean, purely because inventory has been so limited, right? It's really hard. I mean, it's a major home decision, major life decision to buy a home, right? So, I mean, I'll tell you myself personally, me and my wife looked for about 4 years before we bought our first house, right? Like
I remember.
Yeah. So like it was, so bottom line is, understanding your budget, being comfortable with what's going to come along with owning a home, what it means for your family in terms of like, not only for the now, but 5 years from now, 10 years from now, it's a major life decision. So I would say, I have like two extremes of clients. I have clients that look for a year or two, right? That's like my normal clients probably out there somewhere around 12 months. I have clients that get pre-approved and find a house the next weekend. I don't know how they do it, but there's those lucky people out there that just make it happen, and then I've worked with my fair share of clients that have been out there for 4 or 5 years still looking. I mean, I have one client right now that's been making offers. I think they finally just got an offer accepted and we're closing them soon, but it's been a 5-year stretch for them. So, I would say to answer Kenda's question, one last thing is, so a company like us, we utilize the programs that are available through, we lend Fannie Mae, Freddie Mac, Mass Housing, and they do a really great job with certain loan products in certain, census tracts, areas where they offer discounted pricing, lower down payments, and just try to really promote homeownership in certain areas. And certainly we can do better and offer more of those products. We don't, we're able to lend the products that are available to us. And I think Fannie Mae, Freddie Mac, FHA, Mass Housing, hopefully they're all paying attention and do more over the course of the next couple of years, and we can bring those out to those type of areas.
Thank you, sir. Happy to have you.
Yeah, absolutely. This is awesome. Thank you for having us. I think a lot of really great content. Happy to come back anytime you'll have me.
And how do people get in touch with you if they want to get a pre-approval? What's the best way?
Email me, shant@rate.com, or hop on our website at shantgr.com.
shantgr.com.
Yeah, shantgr as in guaranteedrate.com.
Lindsay already hooked you up and put it in the comments.
Very nice, Lindsay.
All right, thank you, my friend. I'll see you soon. Take care.
Thanks for having us.